The biggest scam in life insurance has happened recently, and it all comes down to one major reason and why this happened. If you're new to my channel, my name is Pascal. I've been in the life, health, and retirement space for over 8 years, and I have over 100 clients that I've helped personally in their financial situation create plans for themselves in the future. Based on the current case details, it looks like the agent is 100% in the wrong, right? There needs to be further information in terms of explaining the case details, but as of right now, based on what I've read, there really isn't any defending the agent as of right now. What he did was completely wrong and is a problem with the financial industry as a whole. And the major core thing that it comes down to is financial literacy. People don't understand how money works. And we hear these stories time in and time again. When it comes to financial advisors, accountants, or insurance advisors, screwing over athletes that have a lot of money because they realize that even though a lot of these people are talented, they don't know a lot about money. So they look at it as an opportunity to exploit them rather than actually giving them what they need. If you look at the statistics of financial literacy, you realize that most Americans can't even answer basic financial literacy questions on compound interest and risk management. For example, understanding that investing into blue chip companies that are typically in the S&P 500 are safer than investing into emerging companies that might have a net worth of less than 10 million. So understanding basic things like that in terms of risk management can really help you go a long way when it comes to investing, because it's not just with insurance policies that people get screwed over. You see these stories all the time with other advisors, other accountants, how athletes continuously lose their money due to basically advisors that want to exploit them. And a simple way to avoid getting screwed by a life insurance policy is understanding the difference between max funding and minimum funding. It really comes down to that, basically, right? Because if you look at a policy that's max funded, it's going to have minimal fees. You should be able to have at least 90 to 92% in your accumulation value year one. You shouldn't see a lot of your money just disappearing in fees. If you do see that, it's usually a red flag. If you don't see cash value year one, or there's a decent amount of money not in the accumulation value, that's a red flag. You should see a majority of your money growing and compounding in insurance policy if it's structured for the goal of cash accumulation. The client said he wanted a certain objective. He said he wanted to basically max fund his policy, but the agent did the opposite of that. And when it comes to life insurance policies, there's two major ways you want to look at it. It's either going to be death benefit focused, more death benefit focused, or it's going to be cash accumulation focused, right? The client said they wanted their policy to be cash accumulation focused, meaning they wanted more money for retirement and they didn't care about the death benefit as much. But the agent decided to make it more death benefit focused, because when you make a policy more death benefit focused, it basically maximizes the fees and maximizes the commission, but it also lowers the client cash value. So they're competing goals. When you max fund a policy, it minimizes the agent commissions and maximizes the cash value that the client has. I think the best way to show you guys the drastic difference between the two is to show you just two examples. One policy that's structured for the goal of accumulation, and another policy structured for the goal of just maximizing agent commissions, or maybe just maximizing death benefit. Look at my screen. This is an improperly structured design. As you can see, in the first 3 years, there is no surrender value, which means there's no access to cash. And this is likely how the design was made so they could maximize agent commissions. And you'll realize the cash value, the money actually accumulating, is relatively low too as well in comparison to the money contributed. You see, in this example, I'm showing 4,500 getting contributed to a policy for a 40-year-old male, and you could see that a good amount of it went, in terms of percentage-wise, got taken out of the accumulation value that's growing in the policy. Now, here's an example of a policy that's properly structured with a similar death benefit. Same company, same design, still 40-year-old male, but just a different funding approach to it. So as you could see, the amount getting contributed to this policy is about 20,000 in terms of premium contributed into the policy. And that would be max funding a policy. So in the previous example, he was only contributing about 4,000, which is about 20% of the amount he's supposed to be contributing. Versus in this example, he's contributing the amount he's supposed to max fund the policy to get the max cash value accumulation benefits. As you can see, year one, even within the first 30 days, he'll have access to 20,000 in terms of cash value if he just funds it up front, right? And this is how it should be if the policies focus on accumulation rather than death benefit. This policy has minimal cost of insurance fees, and the expense charges and everything are minimized. The only difference is the agent commissions are completely minimized versus in other example, the agent commissions are completely maximized. Now, I don't necessarily see anything wrong with maximizing death benefit, but if a client specifically tells you that they want to maximize accumulation for retirement income in the future, that's when I have a problem with it. And there should be some repercussions for the agent for not following what the client wants. Because as you can see, it's two drastically different outcomes. And if someone is saving a lot of money in these policies, like it could be very detrimental to them in their retirement future. And when done correctly, life insurance could be a great asset class because it's one of the few asset classes that could protect you from market risk. You can grow tax free, you can access it tax free, and there's no 59.5 penalty, so you could access the money early. And these policies can be designed so you could have 80% access to the cash value year one. So I would imagine in a policy design like that, there were multiple 0 years where you wouldn't be able to access money for the first year or even two or even three. And another terrible thing that happened is he ended up exchanging the policy. He did another internal exchange with the policy from a Pacific Life policy to another Pacific Life policy. And this was just to maximize more of his commissions because the money in the policy was already bleeding. The policy was already bleeding cash. So basically, when he switched the policy again, it basically assumed the loss because whenever you get a cash value life insurance policy, like an index universal life one, there's something known as a surrender charge. So if you actually surrender the policy or forfeit the policy early, there's a cost to that. And the agent made the client or told the client that it would be better off for him to exchange the policy into another one so he could basically get paid again. This is a big no-no in the financial services industry. And also, this person allegedly had some other convictions too as well. So he may not even been allowed to be licensed in insurance to be selling that type of product. So there's a lot of red flags when it comes to this case. Whenever you get any sort of index universal life policy or cash value policy, you want to ask for an expense report so you know exactly what's going into cost and fees. And the three main fees that can be controlled when it comes to index universal life policy is the cost of insurance, the premium expense charge, and the expense charge. If you know these three things, you will never get screwed over by a life insurance policy like this. The premium expense charge is basically an expense charge that's on the contribution of the premium you contribute. So if you contribute $1,000, there might be a one-time 3% or 4% charge on the premium contributed. And this goes to a state guaranteed fund. So if something happens and the insurance company goes insolvent, the insurance company or the state can still pay those claims. So that's the premium expense charge. The expense charge is basically how the insurance company makes money with these policies because it's a lot of administrative fees and things like that that actually build up when it comes to getting an index universal life policy. And what a lot of people don't realize is the insurance company doesn't actually make money until like year 5 or 7 when they get these policies. They actually lose money. So they're depending on the cash flow from the client of continuously contributing premiums to eventually break even. The insurance company would typically have an expense charge for a 10 to 15 year period, which is just a fixed amount. Say, for example, it could be like 1,000 or 2,000 for a 10-year period or a 15-year period, depending on how long the schedule is different for every insurance company. And then after that schedule is over, there's no more expense charge with the policy. And that's another reason why when you start over the policy, it's even worse because you're restarting that expense charge period. So really, when it comes to getting these policies, you want to do it right the first time because if you redo it, it's going to be more expensive. And lastly is the cost of insurance. So people assume this is actually the biggest fee in a policy, but it's actually one of the lower fees when you think about it. Because the premium expense charge and the expense charge are actually, especially in the beginning years, going to be the highest charges on your account, right? The cost of insurance should be the lowest fee, especially if you're max funding your policy. Because when you're max funding your policy, you're doing something known as self-insuring. You're essentially making the risk less for the insurance company, which is going to lower the cost of insurance. So if you actually get a schedule in terms of the price comparison and the cost comparison of your policy, you'll realize the cost of insurance isn't nearly as much as people advertise or say. Is that people, you constantly hear people say things like index universal life is expensive or cash value life insurance is expensive. But when you actually look in the costs and fees in terms of the cost of insurance, it's not that much. And if you're trying to maximize cash value, you want that cost of insurance to be as low as possible. And honestly, if you pay attention to these three fees, you would never have to worry about getting screwed over by an insurance policy. And to be honest, A lot of agents themselves don't even know this about how their policies are designed. So ask an agent if they understand these three charges. Ask them this question: can I see a schedule of these three charges? If they can't answer that question, don't do business with them because they likely do not know what they're doing. If you guys enjoy this type of content, make sure you follow this page. I make content every single week. So if you're trying to improve your financial situation and understand the tools better that are available to you in this financial environment, make sure you follow this page, Financial Ownership, because I constantly make videos trying to help people, business owners, and W-2 employees improve the financial situation. And if you're interested in wanting to learn more on how these type of tools can improve your situation, you could actually book a free call with me. I actually had the link in the bio description below if you want to look more into that and you want to see how these type of plans can fit into your situation. Until then, thanks and have a good one.